Look, obviously technology has changed and TV has changed, and the way we watch TV and get our information has changed. I mean, in the past, like when I was growing up, we had like 3 or 4 channels at 7 o'clock or 8 o'clock, and you would sit down and watch those certain shows, and everybody in the whole country would watch those shows. I remember Thursday nights I would have must-see TV nights with NBC, and we would sit down and watch Seinfeld and Friends and all the shows that were on must-see TV Thursday night in prime time. Well, we don't do that anymore. Now, we don't even watch a show at any time. We stream it, right? So we go down and record it, or we stream it, on demand, and that's how we watch our TV, right? Like, I know I'm starting to do a little bit more binging on Netflix, watching certain shows when I want to watch them. And, let's talk about Netflix, because a lot of people are looking at this chart, and I'm going to show you the chart right now. Look at this chart, and you're going to see this amazing 6x return or 5x return from 2022, which is just 2 years ago this stock was down at 160, and now if you watch this stock you could see it. It's gone through several bases, 1, 2, 3, 4 bases here, right? There's four main bases you see here, and now the stock is here at its all-time high. So what's going on with this now? This is a weekly chart. You can see 1, 2, 3, 4 shots at breaking out, and I believed that Netflix was about to break out, and it just had to get through these sellers. And you know what? Sometimes the third time is a charm. So I'm not saying it's not going to break out. I'm saying that let's just look at the psychology of a chart. So you have this all-time high being made up here in December or January of 2022, right? And so you've got this all-time high. Everybody's been buying down here. All these people that bought at 300 are really happy that they made more than double their money at $700. That's $700.99, and that was the peak. And then what happened? Well, like I've said in prior Netflix videos, Netflix gave you many warnings, especially this one right here with a decent volume break below the 50-day moving average, or on this chart a 10-week moving average, telling you it's time to get out. And this is what happens. People are like, oh, I love Netflix. I bought it here and I made a bunch of money, or I bought it down here and I doubled my money. And then they go, wow, this is a great buying opportunity. And you can see it's gone through its 50-day moving average. Then it goes through its 200-day moving average. And people are like, well, I'll buy even more. So the psychology right up here is very interesting. This is where the weak hands get beat and the strong hands take over. Because the strong hands are like, I'm getting out, and the weak hands are like, I'm going to buy more, which is an amateur move. And what happens is all these people that bought close to the top when there was all this euphoria were like, oh, it'll come back, it'll come back, it'll come back. And they kept it'll come backing it. Look at these high volume sell-off candles, bars. And down here, they're despondent. They're like, oh my God, will it ever come back? And they sell down here. And there's a huge capitulation. All the people that gave up from up here are now giving up, they're getting rid of their stock down here, and other people are like, wow, I think now it's a buy. And they step in with high volume right here. You can see this candle right here, and they start driving it up. And that's what creates this first stage base. Now, obviously, if you can catch a stock on a first stage base, and there were certainly options and opportunities for you to do that, then that's a perfect spot for you to get in. You get in around $200, $230 or whatever, and then you can ride this up. Now, let me tell you, the longer the base count stays in place, in other words, the deeper the base count gets. So this is stage 1, it goes up, make a little correction. Stage 2 goes up, make a little correction and consolidation, goes up on huge volume, and makes a stage. So this is 1, 2, 3. This is stage 4 in here. And so you can see that stock is now trending higher. Well, it's running into all this all-time high stuff, which normally you would say, hey, that's pretty good. There's no more sellers. All the sell-side supply is gone, and now it's just buy-side pressure. And in a green market, which we have, there might be some buy-side pressure. In other words, it's trying to break out. But notice how it's having some trouble. Look at the volume down here on the breakout. It's having trouble like putting together a story to make this thing surge. And so maybe earnings in 29 days will be that story, and now you'll see stuff going on. But what happens is these stocks that run for a couple years tend to have these big corrections. So maybe this earnings per share coming out in 29 days will be a correction for this, which is good for us because this stock has made a run and we want it to make a correction of like 30% and build another base and reset the base count, right? We want this thing to come back here to this 540 level if we like Netflix, because that's really the ideal spot to buy it if we're looking to make a base count run like this, right? If we're just looking to make a quick buck, we might be able to buy it here at 700 and have it run up to, 750. And that could very well happen, but I don't think there's a lot of energy behind that. You'll get an 8% return or something like that if it runs to 750, but there's just not a lot of energy because it's such a late base, right? I mean, if it started here, that'd be different, but it started all the way down here, and all these people are like, oh my gosh, I better take my profit because I don't want this to happen to me again, right? So here's what I would do. Everything for me leads to income because, we don't know if we're right or wrong, but we do get an edge when we sell covered calls. And so I'm going to look at a covered call strategy that's a little bit different from what most people might look at. And that's what makes me weird and strange. But also I'm a little bit conservative when it comes to, recommending and talking about covered calls. I do a bit of a different strategy. And, I've been burned a lot of times. Most people buy the stock, they sell the call out of the money no matter what. I don't always do that. And this is one of those cases. So let's look at the option chain. And the market, by the way, is closed. It's Wednesday today. And the stock closed at 706.91. So what we're going to do, I think that the stock really will go higher, but I want to hedge my bets in case it doesn't, in case I'm wrong. All right, so now we're going to look at the option chain for just 3 days out, okay? This is the 20th. Today is the 17th. So we're going to look at the option expiring here 3 days from now. Now, this is just a way to make a quick buck on this, but let me show you, like the stock was up 10 bucks. It could go down 10 bucks. Here's what I would do. I would go to where I see the option probability, out of the money probability, be around 30%. Okay, so I'm going to look at the 695s. I want to have a pretty good certainty that this stock is going to give me the return that I'm looking at. So what's the return I'm looking at? Well, I'm looking at about, if the stock stays the same, about a 0.6% return. Okay, and if you annualize that, you can see 69.4%. Now listen, I'm only in this trade for 3 days. I may go ahead and renew it on Friday, which is normally what I do as I roll and go to the next week. But right now, I'm in this trade for 3 days. Pretty good. So I've got a 69.4% return if I get this 0.6%. That's like pretty good because the chances of it going out of the money, in other words, the chance of the stock declining, is 28%. I've got basically a 72% chance of the stock staying in the money. I like that chance. And so I'm going to go out and I'm going to sell the calls, right? And I'm going to sell them for, let's call it $15.85. That gives me about, $15 of downside protection, right? And it gives me a little bit of juice for 3 days. And if I get, the stock stays at or above the 695 level, I make 0.6%. If you think it's going to break out, though, you could look at it in a different way. Let's say you think it's going to go up another 10 bucks. Now, remember, the stock is at 706.91. You think the stock is going to go to, say, 715. So you could go there and you could sell the 715s for 485. You think it's going to go to 715 in the next couple days? Hey, it might. And you can get $4.85. That's a 0.7% return, but a 65% chance of being out of the money. So if you're going to get roughly the same return, 0.6 or 0.7, why wouldn't you get the more sure return, right? The higher probability chance, and make a 69% return versus the 0.7, which it says it's a 224% return if you can get 0.7% every day, but you have much less chance, not very little, but much less chance of making that happen. So I hope that made sense. So to me, of these two choices, like one, you're bullish, the 715 is bullish, you make 0.7%. The other one is you're being a little bit conservative, you make 0.6%, right? If it goes down 10 bucks. So which would you rather be? Well, for 3 days, I'd rather make 0.6% and have a high probability of doing it than 0.7% with a lower probability of doing it. Does that make sense? All right, so that's Netflix. We can make a case for a bull thing, we can make a case for a bear thing, a correction, whatever you want to make a case for. The bottom line is, while you're sitting here waiting to make the case, you could be making income. See you on the next video.